Andrew, welcome. So first question out the blocks. How do you manage this psychological pressure of making decisions that will potentially move billions of dollars?
It's good to be able to compartmentalize. It's good to be able to think about it during the day and then turn off. And lots of people who I worked with in the past would be up all night, and that's not good for your longevity in the role. I mean, I think with investment management, you want to make a distinction between the kind of ex ante decision and ex post decision. So the ex ante decision, you control what you do, and so when you're thinking about yourself, or if you're kind of assessing other people's performance, what you do, how you make decisions is, obviously very, very important. And then ex post, there's what happens. That's not something that you control. So you can make good decisions and it goes wrong, and you can make bad decisions and it works out very well. I've certainly done that in the past. So I think you do have to sleep. You can't. There are times when it's stressful, and there's times during periods of market volatility when it's stressful. If you're underperforming, it is certainly stressful. But you need to achieve some balance so that you don't burn out. And the nice thing about investment management is it's an industry where you can do it for a long period of time. I often think if you're a trader at a bank, it's kind of something that you might do for a few years, but kind of a young person's game. But the nice thing about investment management is having seen different market environments, different periods in terms of the recent financial history. There's real benefits to having a team that has done it for a long time. And it's interesting at PIMCO, a lot of the people I work with, we've all been doing this together for a long time. My direct team, managing global portfolios, we've worked together for close to 20 years. So you do have, it is an industry where you can have great stability over time. But, just have to be able to deal with stress is probably the answer.
So a bit more of a high-level question. Where do you think public bond issuance is headed in 2026, both in kind of size levels, but also maybe in growth areas?
So you have gross supply, you have net supply. So net supply takes into account redemptions. So when you look at gross supply, global level, everything, governments, corporates, mortgages, it's relatively flat over year at a high level. Then when you look at net issuance, then you're going to see a decline in terms of government bond issuance. Mortgage issuance in the US will be a bit higher on the forecast, but corporate issuance is going to be a big increase in corporate issuance. And you don't know, exactly what it's going to be. But if you look at the range of estimates, like 30, 40, 50% year over year increase in terms of net issuance is a reasonable range. A lot of that is being driven by CapEx, AI-related CapEx, so, led by the US, but globally as well, and so this is interesting. Big increase in terms of issuance in corporate space. Opportunities for us quite possibly, but at the same time, there may be pressure on spreads, and you're starting in terms of corporate spreads at tight levels historically. So then to have this big expected increase in terms of issuance, it seems perfectly plausible that you could see some widening of spreads.
I wanted to talk a bit more about the data center issuance and I guess the AI boom in general. What do you guys at PIMCO expect from this sector, not only kind of for 2026, but maybe the next kind of 2, 3, 4 years?
So there's going to be a lot of issuance, and it's quite interesting actually, because when you look at the numbers over time, you have the potential for technology to really grow as a sector. Financials is a very large part of the corporate market, 20-25% of outstanding corporate issuance. You have technology having the potential to grow into similar kind of size to financials potentially, depending, a lot of uncertainty, and that's really interesting in terms of a liquid sector, the ability to transact in size. At PIMCO, we over time we're very much involved in financials, banks, in terms of trading for a number of reasons. We think over time there's some excess return there, but it's also reflecting the liquidity, the fact that you can trade in large size. So over time, technology may become similar in terms of its role in the market. Couple of comments. So as bond investors, the upside is getting your money back. If you are an equity investor, the upside is big growth in terms of corporate earnings. So when thinking about AI and capex related investment here, you need to bear that in mind. If you're an equity investor amid all this great uncertainty, you have the potential for really outsized payoffs depending on the scenario. And I think huge amounts of uncertainty about how AI will play out in terms of corporate earnings, in terms of impact on productivity, et cetera, et cetera. But from the bond market point of view, we need to be a bit careful here, and we will be quite careful in terms of technology, the sector, given the extent of the issuance. And then you also have to think about sectors which are going to be negatively impacted. And so, winners and losers in terms of this big development. And then there will be opportunities that come along for us. And our approach in general would be to be quite careful in terms of corporate exposure in general, to be quite careful in terms of exposure to the technology sector. But then there are great opportunities. We did the Meta deal last year, which was a very good opportunity, and we hope that we will find more opportunities like this. And Dan Iverson again keeps saying this in our internal meetings. When credit spreads are tight, by historical standards, there's a lot to be said for going out and hustling, finding deals, creating deals, structuring deals on terms which work for us, work for the issuer as well. More bespoke arrangements, lending against collateral is something very much in the DNA at PIMCO. So asset-backed finance. So you want to be careful. We often make the point that there's nothing kind of magic about private credit. You have a continuum, public and private credit, high grade, high yield, lending against collateral, unsecured lending. For us, investment grade credit, public credit's always going to be a core part of our holdings. One very important difference, obviously, between public and private credit is you can trade public credit, private credit. You may not be able to trade at all or in limited ways. But when I think one of the big benefits of the PIMCO platform is across fixed income, we can look to take advantage of all of the opportunities. Public, private credit is one example. And if you look at the way the market is developing on the issuer side as well, companies that need to raise capital, again, they will be looking at public markets, they'll be looking at private markets. They may come and have a conversation with us. What are we interested in doing? And at a time when you've had multiple years of very strong performance in corporate credit, when you have had some deterioration in terms of underwriting standards, covenants, etc. For us, the option to be able to shape the deals that we want to do, make sure that the collateral is very strong, make sure the covenants are strong. One of the nice things about bond markets is complexity. I mean, if you are on the equity side, a company tends to have one stock. Maybe your American depository receipts, but one stock. Whereas on the fixed income side, a whole plethora of issuers for an institution, and we can benefit from complexity risk premium, liquidity risk premium, and then obviously, and S&P. No secret to an S&P audience, but get the underwriting right, get the credit analysis right, get the compensation for liquidity risk premium right. But then, there's going to be, we think, really good opportunities for us in this environment. And again, a nice thing about PIMCO is when we do find these good opportunities, we can be very selective, but we have the ability to do large-sized deals when the opportunity looks right.
Yeah, you mentioned the Meta data transaction. So just for anyone who kind of maybe has heard of it but doesn't know kind of the details, why was it so significant, and what was interesting about the deal for PIMCO?
So the size of the deal was very large. I'm not going to say what it is in case I get it wrong, but it was high 27 billion. So the size of the deal was large. It was quite a complicated structure. And without going to too much details on the precise deal itself, but stepping back a little bit, if you're a corporate issuer, why would you be interested in a private credit deal? Well, I mean, there's a continuum. You might do public credit, you might do private credit. Depends on the financing opportunity, the terms that are available to you. But with data centers, you may want to do something asset-backed. So this is an off-balance sheet transaction. You may want to agree up front the terms, but then have flexibility on the drawdown in terms of the timing of when you take the payments. You may want to provide collateral. You may want to have, in the case of data services, data centers, service contracts. You may want to negotiate with a small number of lenders rather than the broad public market. Regulatory and disclosure type considerations as well. So I think for the borrowers and for the lenders, there's a lot of interesting development in terms of the market. From our point of view, kind of direct corporate lending to corporates is probably quite mature now. Asset-backed lending for us is very interesting. So it could be against various sorts of consumer receivables. Consumers have strong balance sheets. We can certainly try and get access to the strong consumer balance sheets. It may be infrastructure data centers, it may be equipment, it may be airlines, aircraft, whatever it may be. When you have lending against the collateral, when you can, on our side, when you can be very careful in terms of the credit underwriting, the documents at a late stage in the credit cycle, we will look to have a little bit less in terms of just generic credit exposure. But if we can find really good deals on our side, if we can be flexible, if we can move quickly, this is a very interesting opportunity. And also that it's nothing kind of new under the sun. I mean, we've been doing this for a very long time. The terminology changes, but you've been doing this for 20 years or longer than that actually in terms of private credit. So good opportunities for us, and important to think of the continuum, public to private credit. And the most important thing I think is, or one of the most important things, that credit underwriting is very important. But make sure you're getting paid for liquidity risk. And at the moment, so we're PIMCO, we're bond people, so you won't be surprised that we have a positive outlook on fixed income. But you can get 6-7% yield on very high quality fixed income funds with daily liquidity. So yeah, fine. It's fine to do private credit. There's going to be really good opportunities there for us as investors, for anyone as an investor. But just make sure that you are getting sufficient compensation for giving up liquidity when the starting point in terms of high quality fixed income, 6-7% type yields looks, very attractive to us. Equity like returns or similar to equity like returns, looking back at a historical basis, but then forward looking at a time when equity valuations look quite full, really good opportunity set in public fixed income. So that's, start with that and then make sure we're getting paid for additional risk or additional liquidity risk premia on top of that.
And kind of sticking with the theme of AI, how are you using AI within PIMCO within the investment process?
I think that with the investment process and more broadly at PIMCO, it's a productivity tool. Some of my colleagues have said something on the lines that it frees people up to do less kind of mundane stuff and spend more time on high value added or higher value added activities. I'd say in terms of kind of direct alpha generation, I wouldn't put huge weight on that, at least at this stage. But for our alpha generators, it's a tool that we use quite broadly. I think one of the credit analysis is certainly an area where we use AI, a tool for our credit analysts. Going through the reports, the conference calls, etc., being able to isolate topics, extract information, etc. I think an important area for us, we do a lot of asset-backed lending, a lot of real estate mortgage lending, and it's a very useful tool in terms of the ability to assess credit quality, extract information in terms of individual loan level data. You have masses of unstructured data, and you can use AI tools to help you organize data. I think on the private side of the business, I think we have tools that we use there. Again, organizing information, organizing data. The classic example would be in a deal room type of situation, rather than kind of having people stay up all night pouring through the documents, organize information across different data sources in that kind of context. There's sentiment type tools that we use. There's forecasting tools. There's forecasting tools we've used for a long time. We used to call it different names, neural networks, or whatever the term was back then. But there are forecasting tools as well. And then with my client-facing colleagues, there's all sorts of things that they use now, and in the future they'll be able to use in terms of reporting to clients, organizing information. So I'd see it as a productivity tool. I'd see it as work in progress. We have a lot of quantitative input into our investment process. We have really good quantitative teams. So the quantitative aspect is very important in terms of the investment process alpha generation. I'd say that AI at this stage is more in terms of supporting our portfolio managers, our analysts, and quite a broad range of things.
And when you personally visit the clients of PIMCO, so the pension funds, sovereign wealth funds, insurance companies, what are their priorities right now? What are they kind of asking you about?
Well, it's hard to get away from the discussion on the US administration, because this has been very impactful, and for us as active managers, it's been a very good environment. The last year was a really good environment for PIMCO, but for active management in general. So I think you have a lot of focus on. I think the first point would be the U.S. administration and the global implications of the U.S. administration. I think you have a lot of focus on fiscal and issuance, which we have talked about already. And then I think another discussion we have a lot, and we think it's an important discussion, is kind of the move from cash into core fixed income. If you go back to the repricing in 2022, this was an excellent time to be in cash and a painful time to be in bonds or equities during that period. Interesting, unusual time. Inflation as the driver for both fixed income as well as for equities. But then subsequently, this has been a very good environment for fixed income, and an environment where the return on cash is going down, giving central bank easing. So I think a lot of focus as well on the shift into core fixed income and the benefits of core fixed income in this point of the cycle. And then I'll talk my own book. I think there's a lot of interest in terms of global fixed income, a lot of interest in emerging markets as well, and we see a lot of benefits in terms of global diversification in an uncertain environment when there's a really good global opportunity set. So we have a lot of discussions as well in terms of the benefits of global diversification. A lot of interest in private credit, which we have discussed, and again, a nice thing for PIMCO. A nice thing about working at PIMCO is you spend your time. You have this global opportunity set. There's all sorts of things that we can do, and you spend your time thinking about risk-adjusted returns, how to get the best risk-adjusted returns for our clients, across the full opportunity set across government bonds, corporate bonds, emerging markets, asset-backed securities, public, private. That's what you spend your time focused on.
So, your older brother Ed went to Oxford and studied PPE, and you did the same. Ed then went to Harvard for his master's, and you did the same. Ed went to the FT, and you did the same. Ed then went into politics, but you chose to move into PIMCO. So, interested to know, what was it about finance or investing that attracted you, and was politics ever on your kind of roadmap?
No, we did similar things. You could try and get scholarships. We both went to the same university. You could try and get the scholarship, so it's kind of a standard thing to try and get that scholarship, which allowed me to go to study in the US. And then I spent 8 years at the FT, which was great fun. I worked with Martin Wolf, which was excellent, and writing editorials, leaders, and then I did Lex, the Lex column there.
Of course, yeah.
And then I was in the US covering the Fed and the US economy, so that was great fun. I don't think I was ever particularly going to go into politics. I think one member of the family was enough, but I was always interested in economics and markets policy, and so I went and worked at PIMCO, and so I loved being at the FT. If you're interested in economics, markets, macro policy, then being the US economics correspondent at the FT was good fun. And then when I moved to PIMCO, kind of half the job is similar. You're thinking about the, well, maybe not half, but a good portion of the job is similar, and then you are thinking about how this relates to trades and markets. But a lot of the topics. When I started at PIMCO, I spent most of my time on global central bank watching. which was pretty similar to what I was doing at the FT.
So when you, I mean, it's kind of an interesting move from the FT to PIMCO, and not kind of a tried and trusted, people going from journalism into managing money at an enormous investment manager. When you moved across, did you initially manage money, or is that something that you took on later? And also, how did you get the role at PIMCO? Was it an open interview, or was it just connections?
So when I was at the FT, I got to know people at PIMCO well. I got to know Mohammed Al-Arian very well, who subsequently was the chief executive at PIMCO.
Two-time guest on Leaders, by the way.
Oh, is it? Excellent.
Yeah.
Good. And he was co-CIO. And I got to know Paul McCulley. Do you remember Paul?
Yeah, I remember Paul.
Paul McCulley very well. And so that was my introduction. And it's interesting. I think it would be harder now. When I joined PIMCO, US total return was, I don't know, 2/3 of the business, probably more actually. So we spent a lot of time focusing on the Fed, the US economy. So when I joined, I wasn't sure I would have much clue what was going on. But the first day I was there, I was in the investment committee talking about the Fed. So that wasn't quite, it was familiar territory. And then I was meant to be our global swaps trader. I think I'd have done a poor job at that. But then Lehman defaulted, so I didn't do that. And I started off. I was a strategist and focused on policy. And then I started managing money a couple of years after I joined, initially in the US, and then I moved back to the UK.
And did you always have kind of an eye on managing money, or was it being in the role for a couple of years you thought, actually, I could kind of give this a go, I think this would work out for me?
So when I was at the FT, I was interested in markets. I was interested in policy, economics. I had a good idea. I probably wouldn't stay at the FT forever. I mean, most of my friends from there, people moved on and did different things. But I didn't have a plan to manage money, so I did that. And you have an opportunity. You manage small number of portfolios. Do you do a good job? And if you do a good job, then you do more. And managing money is if you're competitive, if you have views. The nice thing is, you get to keep score because every day you have your P&L. So we talk a lot. We spend a lot of time analysing, discussing issues at our investment committee. But ultimately, the P&L shows on a trade, or overall shows whether you're getting things right or wrong. So if you're interested in these topics and you like to keep score, it's a very good thing to do. And then a nice thing about PIMCO, this goes back to Bill Gross, is the focus on alpha and clients. On the investment side, the investment process is about generating returns for clients. It always feels a bit exhausting the first week of January because we had a very good year last year, and now the clock resets and we have to start again rowing the boat. But the culture of the firm is alpha generation and having investment products which make sense for clients, and so you get to manage money on behalf of a very broad range of clients across the world who trust PIMCO with their money.
So, be interested to know. You mentioned Mohammed Al-Arian before. You're sitting inside kind of arguably one of the most influential bond houses in the world. So, what kind of lessons have you learned from working alongside these great investors, or your colleagues at PIMCO?
So Mohammed, I learnt a lot about macro frameworks, and 2008 was really interesting because Mohammed had been at the IMF, had a lot of experience from his IMF days of crisis management. So I learned a lot from him in that time. We had this investment committee, and Mohammed and Bill were running it, and the job was write down 30 policy interventions that you think may happen after Lehman Brothers defaulted. So I wrote down 25, and I was kind of laughing the last half dozen, but about, I don't know, most of them happened. And the world really changed there in terms of the government intervention, incredible range of interventions you saw in the US and then globally. I learned a lot from Bill Gross, and we've added to it and we've improved it, and we have more of a quantitative focus, I'd say, today than we perhaps had at the time. But most of the investment framework that Bill Gross developed, starting more than 50 years ago now, and I learned a lot from Bill. One interesting thing is if you're an investment manager, you need to think about the baseline and the risks around the baseline, and then you compare this with market prices and you look for asymmetries. Whereas if you're a central banker, you have to do point forecasts, and you have to show you're working in a different sort of way. So one thing I thought was really interesting in the run up to to Lehman Brothers is PIMCO had figured out the scale of the problem in financial markets and the risks, and we were too early, which often happens a year or two early. But when you talk to central banks about what was happening, they would say, we understand everything you're saying, but we can't model this, we can't forecast this. I mean, the classic thing is it's really hard to forecast a recession because it's always a surprise. And as an investment manager, one thing I think I learned from Bill was thinking about not just the baseline, but the range of outcomes, and then looking for the asymmetries. And if in that case, if you figure out, as PIMCO did, that you're going to see massive easing cycle across the world, you position for that. And I can't remember what yields were, policy rates were 5-6%. If you think they're going down to 1, then there's a massive asymmetry because they're probably not going up to 10. And then be patient. You're not always going to get the timing right.
So, final few questions now. What does Andrew Balls, in one of the most highly pressured role in global finance, do to just relax and chill out?
I play the drums.
Me too.
Which do you?
Yeah.
Which is a nice thing to do. I did that last night when I got home. So that's
taking out any stress from.
That's a good thing to do. Like the first 20 minutes when you get home. What do I do? I spend a lot of time watching my son play football, which is great fun, and I've done that a lot over the years. And then my family were Norwich City fans, probably a bit less fun with second to bottom of the Championship. But
well, me and my family are all West Ham fans.
Oh God!
So we're in the same boat.
No, well that's tricky as well. So we may be seeing you next season. Actually, we may not be seeing you next season.
Oh, there we go.
So no, I go to a lot of. 10 of us went the other week. 10 of my family, we all went the other week as part of the Christmas holiday. So that was good fun. So.
Any favourite books or podcasts right now?
I like to read books on history. I like podcasts on history. I like the. I do listen to The Rest is History. I listen to that in the car with my family quite often, or if I'm cooking or something. I like I was lucky enough to have dinner a year or two ago with the hosts of The Rest is History, which was good fun. Football, history, podcast, books. I've never read them before, but I'm reading the Simon Sharma books on British history at the moment. I'm halfway through the first one. I shouldn't say I'm reading them, but because when I was at school, there's certain things we just didn't study. We did the First World War, but we never really did. And there's whole bits of history I don't know, so I'm filling in the gaps a little bit there. So there we go. Drumming, football, What else? That's probably the most.
Well, Andrew Balls, thanks so much for joining me today.
Nice to talk to you. Thanks for having me.